started. Today is Monday, October 10th, 9:30 a.m. section. This class is being recorded. First things first, this is the sign-in sheet. Make sure you sign the sign-in sheet before you leave today. Start over here. All right. So before we get into our content for today, which is basically covering homework 6, as well as some additional practice on the ROIC trees and CFIs, I want to just cover a couple of upcoming logistics that are coming up. So again, today is Monday, October 10th. Looking at the assignments. Next Monday, which is right here for group projects, October 17th, you will be presenting your second team project on the historical analysis. All right, so later today, I will put up both the ROIC tree and the CFI for Dentsu, and that is the company that you're going to be presenting next Monday. All right. So again, just like the first presentations that you did, everybody must participate in creating the presentation, even if you're not actually presenting. You can decide who's going to be presenting on behalf of your team. You will have 10 minutes. I'll do a countdown timer, so you have to be done within the 10 minutes. You have to cover both the CFI and the ROIC tree in that 10 minutes, so approximately 5 minutes each. For the ROIC tree, besides using numbers throughout, you must cover both levels of the ROIC tree, explaining the drivers, the first level drivers, the second level drivers, covering all of the drivers for Dentsu, so both income statement as well as balance sheet. You must also go through all 4 sections of the CFI, operating cash flow, non-operating cash flow, CFI, debt equity cash flows. And again, you're no longer just talking about the totals, you're talking about the intervening years. Okay, so for the ROIC tree, it's not just year 1, year 5. It's not just the total of the CFIs. You got to talk about the key elements that are happening as drivers in the intervening years. Again, we'll talk more about that today as we go through the homework 6 solution and some additional practice. All right, but that's going to be your second team project next Monday. All right, you'll turn in your PowerPoint before the class starts. Everything that you're going to be referring to must be on that PowerPoint. We won't accept anything that's not on that PowerPoint. All right, questions about your second group project? Presentations. Okay, so that'll be next Monday. Next Wednesday will be your midterm exam. So it will be held during the time that you are registered for. Okay, so this is section 301, which meets from 9:30 until 11 a.m. So the midterm will be available between 9:30 and 11 a.m. Okay, it'll open up at 9:30. It will close at 11. You will take the exam on ELMS. Okay, basically the exam is just going to be an Excel file. Right, it's basically going to be an income statement and balance sheet in an Excel file with the labels, and you're going to convert it. You're going to create 4 tabs within that Excel file, TII, TFI, CFI, EP, that balance, and then you're going to submit the balancing statements by the end of your exam period. That's it. There's no write-up. Now I will say it is open book, open notes. You'll obviously need a computer for Excel. You can review any material that we've covered this semester, including the practice exams, which I will post this week. However, it's non-collaborative, right? And you cannot use a solver, right? So that means that if you attempt to use a solver to do the midterm exam, I will consider that an honor code violation, and you'll be in front of the honor council. Okay, so what I mean by a solver is you can't basically take the data, put it into a pre-arranged file that automatically converts. Okay, that is not allowed. You have to convert it in real time by yourself, which means you cannot use another Excel file to do your midterm exam. Anybody that turns in not the file that you download and convert in will be sent to the honor council for an honor code violation. Okay, that is an honor code violation in this class. You cannot use another file to help you do the economic statement conversion. That means you must download the Excel file. In the Excel file that you download, which will have a watermark in it, you will need to basically create the 4 tabs, save that file, and re-upload that file. Okay, you can't take the data, copy and paste it to another file, and do any other work. That is not allowed. Okay, as an individual file, you have to do this yourself. You can't do this collaboratively. There's no sitting around with a bunch of people doing the conversion. Right? You can't turn in somebody else's file. That was the worst of all the sins. Yes, sir.
Would we be able to use a solver to check the work?
No.
Okay.
That would be considered an honor code violation. So no solvers, it's full stop. Okay. The solver to check the work is that you converted statements that balance. That is your check of work.
Okay.
All right. So you can look at other things that you've done to give you ideas on where to put things, but you can't use another Excel file to do the work. Yes?
We can't like copy paste it into other Excel files, but we can refer to other Excel files, right?
You can refer visually to the work, other Excel files that you have done this semester.
Okay.
But you cannot copy and paste from those Excel files or to those Excel files. And based on his question, you can't type in all the data into the other Excel file, solve for it, and type in all your data to finish it. I fully expect you to do the work in the Excel file that I gave to you. Okay, that's all next Wednesday's class. So next Wednesday, you don't have to physically be here to do the exam. It will open up on Elms. Now we're talking about October 19th. All right, during your registered time, the exam will be available right at 9:30. So you go in, do it, and it will close right at 11 a.m. Okay, so you must submit that file back by 11 a.m. If you have any trouble submitting that Excel file, minutes matter. I will look at a timestamp on your email. So if it's 11 a.m., and you're having trouble submitting, and because that link goes away at 11 a.m., okay, then email better come to me at like 11:01 saying, I had trouble submitting, here is the attached Excel file. Don't send me an email at 11:01 saying, I had trouble with the Excel file without an attachment, all right? And then 20 minutes later, say, oh, by the way, here's the attachment, because then you're going to get a 0 on the midterm exam. So if you do have technical difficulties, minutes matter. I will look at timestamps. Right? It is not fair to the other 160 students across all the sections to give you more time to do the conversion than they have. 90 minutes means 90 minutes. Okay, unless you have an ADS accommodation. Right? For those of you that have an ADS accommodation, there will be a different midterm link. It will be called the alternative midterm. The only people that should be taking the alternative midterm gets explicit permission from me to take it. The difference between the alternative midterm and the regular midterm is the alternative midterm link will not have a 90-minute timer because some people, because of an accommodation, get longer than 90 minutes. Okay? So if you have any accommodation, you will take the timer, the exam without the timer, but you still must complete it within the accommodated time. Okay. The only other people that should be taking the alternative midterm link is if somebody has some sort of issue, that personal problem, whatever, that, you know, I have COVID, I can't take the exam during class next Wednesday, and then they get an accommodation when they could take it at a different time. Those are the only people that should be taking the alternative midterm exam. Everybody else needs to take the midterm exam regularly scheduled class time. You'll just take it on Elms. All right, again, questions about midterm or group project next week. All right. And then as a reminder, the Bloomberg Trading Challenge ends next Wednesday, October 19th at 5 p.m. Okay? So what's going to happen is don't liquidate your portfolios, all right? Because if you liquidate the portfolios and you end up with more than $300,000 worth of cash, then you'll be disqualified, okay? So at the end of trading, basically after 4 o'clock, on that Wednesday, I will go in and I will basically take a screenshot of all of the rankings. And you will be ranked, as we've been talking about when I showed you examples, based on total portfolio value from highest to lowest. Okay? Assuming that you were not disqualified, and I'll just talk about the 2 important criteria in a second, then basically points will be distributed, 5 points to the team that has the highest portfolio value, 4 points to the second and third place teams, so 5, 4, 4, and then 3 points, 2 points, and 1 point for the 4th, 5th, and 6th place teams. Okay, so that will be the distribution of points, assuming you're not disqualified. two things that are important to keep in mind. Stay above 300,000 of, under 300,000 of cash, stay in equities the entire time, including the final day. And the other key point is make sure you have 10 longs, okay, by next Wednesday, right? Because if you don't have 10 longs, doesn't matter how short you have, you'll be disqualified. So make sure you have 10 longs and stay out of cash, okay? And then it's just relative ranking. Then the following Monday, I'm trying to do this math here, was that the 19th, 5 days later is about the 24th, whatever that Monday is. The competition will reset for the second half of the semester. Same teams, same captains, everybody starts out with $1 million worth of cash, just like you did 6 weeks ago. Okay, so if for some reason you did really poorly in the first half, all is not lost, you can do the second half. Your portfolios will all be reset. Okay, if you did really well and you're like, gee, I like my portfolio, buy it again. Okay, but nonetheless, the competition will reset that following Monday for the second half of the semester. All right, so those are just some logistics things that are kind of coming up. Let's talk about homework 6. So for homework 6, you needed to do the RO, and unfortunately, because I'm recording, it won't let me switch to the full screen without stopping the recording. So I'm just going to have to deal with this view of my PowerPoint. Can't go full screen. All right. Oh, actually, let me try this. I think I can go full screen on the PDF without stopping the recording. Aha. All right, I think the recording is still going. All right, so I'm going to start with the ROIC tree for Nokia. All right. So as I said, at a minimum, you will do the 5-year ROIC tree trend. All right. So starting with 2017, Nokia's ROIC was negative 2.8%. By 2021, it had grown to 21.3%. Now, a couple people asked about this even last week, and they said, oh, it's got this really weird percent change, right? Because that's a 5-year percent change, and when you go from a slight negative to a very big positive, you're going to get a crazy percentage change. So what matters here more is not the negative 870% change. What matters here more is how they went from a negative 2.8% ROIC to a positive 21.3% ROIC over the 5 years. That is what you're primarily explaining. Now, when we look at Nokia, we also see that it wasn't just a straight line, meaning negative 2.8 to negative 1 to negative 0.8 to negative 35 to 21.3. All of that positive ROIC improvement occurred in 2021. It was negative for 4 years going into that. Okay, this is what I mean by starting to talk about the intermediate trends. So next, we start looking at the 3 drivers. All right, so the first driver was the cash tax rate. In 2017, their tax rate was negative 182%. Okay, and you saw some crazy cash tax rates over the 5 years, culminating with a 14.3% tax rate in 2021. Again, here's the problem. When you lose money, you can get a refund. That's how you get negative taxes. You also can see some other tax benefits because you got some deductions or loss carry forwards, etc. And so really, when we try and explain what's going on with Nokia, the tax rates are not a good explanation because of their losses and other financial issues. The only tax rate that probably matters is the 14.3% in 2021. That's probably a more realistic tax rate for them when they're profitable going forward, but it's really hard to explain what's going on with their ROIC because of the tax rate, because of the losses that they were experiencing. So really, the tax rate is probably not a factor as much in what's driving that end of year ROIC. All right, and you could say that. Right? What you then would say is, okay, the pre-tax ROIC is really what matters here. And the pre-tax ROIC went from negative 1% in 2017 to positive 24.9% in 2021. And again, most of that improvement occurred between 20 and 21. Although if you look at the pre-tax business, it was negative the first 2 years, -1 and then -0.6, improved to a positive ROIC in 2019, and then a more positive ROIC in 2020 of 9.8% before jumping to 25. Okay, so really it was a 3-year trend of positivity, but again, most of the improvement occurred in 2021. So what was behind that? Again, drivers 2 and 3. If we look at the operating margin from the income statement, we can see that on an operating basis, they were losing money in 2017 and 2018. Right? Their operating margin in 2017 was negative 0.04%. Okay? And in 2015 was basically break even, right? Slightly negative 0.003. Right? So the reason for the negative ROIC in the first 2 years, 2017 and 18, is because they were experiencing losses. Right? They turned to a slight profit in 2019 of 2.5%, going to a 4% margin by 2020, and jumping all the way to a 9.5% operating margin by 2021. Okay? So that was the biggest driver, the 9.5% operating margin, of why their pre-tax ROIC jumped to 24.9%. Okay? Now, looking at productivity, we can see there was a change in Nokia's productivity on their balance sheet. In 2017, they were spending about 45 cents, 0.449 cents per dollar of sales in investment. Okay? By 2021, it fell to 38 cents per dollar of sales of invested capital. Okay? So they got more efficient. That also helped their pre-tax ROIC. And you'll notice that efficiency improved in 2018 to about 40 cents, got worse in 2019 to 44 cents, improved to 41 in 2020, and then 38 in 2021. Okay? So we're also going to start to highlight what happened in 2019 that basically caused the blip in the 5-year trend, but over 5 years they did get more efficient in their balance sheet. So drivers 2 and 3 both improved their pre-tax ROIC, but the biggest driver was going from a negative 1% to a 25%, was basically the operating margin going from negative 0.004 to 9.5. That was the primary reason they started generating a positive ROIC and a positive profit. Okay? Now, continuing on to the income statement drivers at the second level, how they go from losing money to making 9.5 cents per dollar. Well, we can look at their gross margin first, and we can see that the gross margin was pretty flat. It was 46.4% in 2017, and it fell to 44.7% in 2021. So it wasn't that they were getting better margin on their products. Okay? That was actually compressing. Right? And if we look at the compression, we can see that it compressed immediately. Between 2017 and 2018, it went from 46% gross margin to a 43% gross margin. Right? They improved slightly in 2021 from 43 to 45%, but it's still lower than when they started in 2017. So it wasn't the gross margin that helped their operating margin. The real thing that helped their operating margin was selling general administrative. They slashed their overhead. Right? In 2017, they were spending 41.4 cents per dollar on SG&A. By 2021, they had cut that to 32 cents per dollar. So even though their markup was going down on their products, they spent a lot less on indirect expense to run their business. Right? That was the primary improvement in operating margin. A secondary driver of improvement was that depreciation went from 6.9 cents per dollar to 4.9 cents per dollar. Okay, so they did improve in depreciation as a percentage of sales. But the real reason their operating margin went from negative to positive and improved so much was the drop in the SG&A. That was the primary driver. Now, looking at the balance sheet, the reason that Nokia got better on its balance sheet from an invested capital sales standpoint was clearly 3 things. 1, working capital went from negative 3 cents to negative 6 cents over the 5 years. Right? So they have more negative working capital. And we talked about how negative working capital improves your ROIC because you have less investment. So assuming that your vendors aren't getting pissed off that they're not getting paid, then generally that helps you. So overall, that was one of the reasons why they had less investment in their business. Property, plant, and equipment went from 8 to 13. So it wasn't like they weren't spending on facilities. They were actually spending on facilities and equipment that went up by essentially 4 cents per dollar. But they benefited because of the improvement in the working capital, kind of almost offset that, right? But the real benefit came from intangibles. Okay, their spending on intangibles went from about 40 cents, 39.8 cents per dollar in 2017, They're 31.8 cents in 2021. Almost an 8 cent per dollar drop in spending on goodwill and intangibles. Now, if you remember historically, Nokia had made 2 acquisitions. Okay? But the big one was Alcatel-Lucent. Okay? So really, that reduction in intangibles was probably related to their Alcatel-Lucent acquisition. Right? So basically, that was the real driver of invested capital to sales going down. So if I really want to look at why did Nokia's pre-tax ROIC go from -1 to 24.9, on the balance sheet, it was the improvements in the goodwill and intangibles, along with the improvements in working capital. That's about 11 cents combined between the two, along with the reduction in overhead SG&A expenditures going from 41 to 32. It's about a 9 cent per dollar improvement there. That's why the operating margin went from basically a slight negative to 9.5%. That's why the productivity went from 44.5 to 38.3. And the combined benefit of the two sent their ROIC from -1 to 25. Okay? Again, with a 14.3 tax rate down to 21.3 after tax. That's the ROIC tree. Now, that probably took me more than 5 minutes. I was very, very detailed. But basically, those are the types of things that you need to cover. So I think very next week, you should be scripted just to make sure. Like, I wouldn't just have somebody for the very first time come up here, start looking at the screen and try to riff on that, right? I can do that. I've been doing this for years. You try to do that, 5 minutes is not going to go very well. So I would practice, make sure you know what you want to cover, have it all laid out. You can even use some colors to highlight the ROIC tree. Arrows, colors, whatever, might help you even visually talk about some of the key drivers that you want to do. I've seen people do that in the past. They'll use green for improvements, red for going down, or they'll use up arrows for improvements, or down arrows for going down as drivers. Consider adding that to your presentation. All right, that's the ROIC tree analysis for Nokia. Questions about the ROIC tree? Hopefully everybody was able to do something similar to that in your write-ups. Okay. Let's talk about their CFI. As we said last week, when you do a CFI analysis, you begin with operating free cash flow. That's where you start. You start with that number. In this case, I'll start with the total, which was $1,997.6 million. Again, because that's a positive number, they're generating more cash than they're reinvesting. So a lot of the framing of where we're going to go with the analysis is where did that $2 billion, it's probably euros actually, 2 billion euros actually go, okay, in the other 3 sections. But starting out, how do they generate 1.997.6 of free cash flow in the total? Well, they generated 5.15 billion of gross cash flow. That's probably euros. I should stop saying dollars. Over the 5 years. Okay. Now, if we look at the trends, 2017, that gross cash flow is 1.3 billion. By 2021, it had grown to 2.9 billion. Okay. So essentially, they've been improving the profitability from their income statement, with the one exception of 2020. They had a big operating loss of 3.3 billion, which was 2 billion of gross cash flow negative in 2020. Okay, so obviously that year was a little bit of an aberration. Right? Did anybody look at why? Like what happened to them in 2020? Because I'll go back to, if this were next week, and if Nokia were the team that you're presenting, when I talk about the intermediate years, like that's an outlier year. That's something that, you know, one of these things does not look like the other. And it's very, very much an outlier. So something happened to them that year. So we would want to at least go investigate that and have some commentary on why that changed. So when I talk about what I expect next week, when you're looking at Dentsu, if you see a big outlier, that's what I want you to probably explain. And this would be a big outlier, right? Now, 5.1 billion of gross cash flow on a total 5-year basis. They reinvested 7,062 million of gross investment. That worked out to 137% reinvestment rate. Okay. with the exception of the outlier year 2020, 2017, 2019 were big investment years, 110%, 237%. 2018, 2021 were relatively small investment years, only 42% and 20. So even though they averaged 130%, 37% reinvestment over the 5 years, it wasn't consistent each and every year. Okay? It was kind of like big spend, slow back, big spend, slow back. Okay? So it's really more of a 2-year trend than a 5-year trend for reinvestment. But still, over the 5 years, they were trying to grow. Now, that was before acquisitions. If we look at acquisitions, most of their goodwill was just negative. So they were just writing down previous acquisitions. It didn't look like they were making large acquisitions during the 5-year period because goodwill was almost negative $4 billion, negative $3.9 billion, which led them to essentially a positive free cash flow of $2 billion, not from operations, but because they were writing off the goodwill. Okay? So essentially, with a negative $1.9 billion of free cash flow, if I look at the ratio of capex to depreciation, it was 112%. Okay, so over the 5 years, they were investing more than was depreciating. Okay, and again, it goes back to the 137% reinvestment rate. They were investing more than they were generating from their income statement. Okay, with the one exception of 2020, which is like an outlier year. Generally, the capex depreciation ratio was right around 100% until 2021 when it jumped to 120%. So the other thing is that for 2022, they are signaling some expected growth, right? And again, if you're doing any reading, it's probably related to 5G. Okay, 5G is finally starting to take a foothold. They are one of the big providers for the back end of the cell phone companies for 5G. And so hopefully 5G takes off. I mean, that's actually been the problem. The 5G promise and the switch from 4G LTE has been talked about for a number of years, but the carriers have been in no hurry to upgrade us to 5G because two things. 4G is relatively not much slower than 5G at the current implementations for most of us. And number two, they hadn't really fully paid off their 4G investments. And then they had to turn around and spend just as much to start 5G. And they haven't paid off 4G, and 5G is not that exciting for consumers yet because the true speed benefits have not really been realized over 4G LTE. So if you kind of look at it, the carriers have been kind of slow rolling the 5G implementation. And that's hurting companies like Nokia. And so the question is how fast we convert to true 5G is going to affect what they're going to do with long-term sales. And that's the kind of key to understanding what's going on at Nokia. Hopefully it gets a little bit better for them in 2021. Their spendings tend to suggest that, but that's an issue they play out in their EIC. All right, so given $2 billion of free cash flow, how did they get to $1.7 billion of CFI? If we look at the non-operating cash flow over the 5 years, what we can see is that they basically had essentially FX gains of almost $342 million. We also saw essentially an extraordinary loss of which one's the 174? 174 is, the extraordinary gain net of the tax loss of $174 million, most of which was in 2018. And we can see that from an excess cash standpoint, stayed relatively flat, negative $11 million. Because the first few years, 17 and 18, they were drawing down their excess cash reserves, $1,030,000,000, $1,454,000,000. In 2021, they were adding to their excess cash, about $2.1 billion and $1.3 billion respectively. So over the 5 years, what they started to draw down in the first 2 years, they pretty much put back in the last 3, or the last 2. Okay? And they also had some miscellaneous adjustments that increased on the income statement, reduced their CFI by about $246 million. So again, nothing really changed dramatically between their operating free cash flow and their CFI of $1,740,000,000. But as I said, there were a couple of trends where they were kind of using some of the cash and putting it back was kind of the big change, even though it netted to zero over the 5 years. Now, how did they distribute the $1,740,000,000? Well, $995 million went to after-tax interest expense. Debt went down. Was increased by $1.5 billion. Now they paid off debt in 2021, $720 million. They increased debt in 2019 and 2020, right? Now, part of the reason they were probably able to pay off the debt in 2021 is because that was the year they returned to profitability. Okay? And they're not making huge investments in capital expenditures relative to the profits. So therefore, they actually had some cash that now that they're profitable, to basically pay off some of that debt. But over 5 years, they did increase their debt. And they also increased their retirement-related liabilities. Okay? So basically what it means is they owe more money to their employees for pensions that have not been fully funded. And so they're using that money in the business rather than fully funding the pensions. Well, that's a liability to the employees. It's kind of like issuing new debt, because when you pay it back, you're going to have to pay it back plus some accumulated interest on what those pension funds would be earning. So therefore, $1.592 billion increase in retirement-related liabilities, right? And, $1.592 billion is what they paid down their pension liabilities. Sorry, said a different way. I said increase. That's not a negative. It's actually a positive. So that was a pay down of the retirement-related liabilities. So say it's the other way. They're actually putting money into the pension to reduce it. Kind of like paying off the debt. That's what I should have said. They've also basically given minority shareholders a reduction of $779 million, all of it occurring in 2017. Right, so they basically paid off a minority shareholder, or a big chunk of the minority shareholder, in 2017. If we look at dividends, they paid out $2.8 billion worth of dividends over the 5 years, but notice that almost all those dividends were paid in 2017 and 2018. By 2021, the dividend was practically zero. So as they were losing money, they started cutting back on the dividends. Okay, and the question now is that they're profitable, will they restore that dividend? Right, now what they also did is, if you look at the share repurchase, they bought back shares in 2017, but they haven't bought back shares since. So again, it goes back to when you're losing money and you're kind of starved for cash because you don't really have a lot of free cash flow, then you probably don't want to increase the dividend. They started cutting back on the dividend, and then they stopped buying back stock. All right. So that's one of the questions for Nokia is going forward. If they remain profitable, will those be restored? All right. But if we look at it, what did they really do with the $1.7 billion worth of CFI? Basically, most of that was paid to dividends, primarily in the first 2 years. All right. That's the CFI. And as we look through goodwill, as I said, there were no acquisitions they really did of any substance. Questions about Nokia's CFI? Questions about Nokia's ROIC tree? Questions about what you're going to be presenting next week in terms of either of these? Okay, great. So let's do some practice. So the rest of today, I put up in the file section this morning a file called where did I put it? Did I put it up here? Oh, here it is. KVD 2022.PowerPoint. Okay, KVD stands for Key Value Drivers. Okay? So you might want to go grab that PowerPoint file. That PowerPoint file is, where is it? That PowerPoint file is, let me just download it. So I don't want to go looking for it on my laptop. Why am I not finding this? All right. I know I'm not blind. Where is it? Where'd it go? I know I was looking at that file a second ago. Did somebody delete it by mistake? Were you able to get to that file? Is it still there on your screen?
If you sort by like date created or date modified,
You could search for files too.
I'm going to search for file. That is bizarre. You're seeing that I can't see the file that I uploaded that I just showed you. I don't know what's going on. There's a ghost in my computer. All right, I'm going to download this file. That's really weird. Anyhow, if you search for the file if you can't find it, but KVD-2022.PowerPoint. What I did is I basically did the CFI analysis for Raytheon against Lockheed Martin. And what I did is I put both trees side by side. Okay, so we're going to do a quick walkthrough of the defense and aerospace industry. So we got Raytheon versus Lockheed Martin. Then we have Raytheon, same ROIC tree, against Northrop Grumman. And then as a third analysis, we have Raytheon against General Dynamics. Okay, so there's basically 4 ROIC trees in here. Raytheon is the consistent theme across all 3 slides, and then I'm just benchmarking their ROIC against peers. Lockheed Martin, General Dynamics, Northrop Grumman. Okay? And so that's the other way that we might do this analysis, meaning we don't just look at one company historically, we kind of look at some of their peers and see how they're doing against their peers as we're doing this analysis. Okay? Everybody with me so far? So here's what I want you to do. I'm going to stop this video recording in just a second, and I'm going to give you essentially 10 minutes, and I'm going to ask this, what do we got, 2, 4, these 3 rows right here. I want you to do the first slide, Raytheon against Lockheed Martin. Okay? Walk through your own ROIC tree analysis and compare and contrast who's doing better and why. Right? These 3 rows, this one, and this one, I want you to do the next slide, Raytheon against Northrop Grumman. Same thing. Look at both of those, analyze it, who's doing better, why. And then the final 2 rows over here on the right side of the room, you get the last slide, which is Raytheon against General Dynamics. Same concept. So I'll give you guys 10 minutes. You can kind of collaborate amongst yourselves, groups 3, 4, 5, however you want to do it. In 10 minutes, we will debrief this. And we're going to go through the ROIC trees. We're going to add to it an element about where's the differences between the peers, which ones are doing better. Are they performing similar? Are we both seeing similar trends? Are we seeing differences? What can we learn by doing the ROIC analysis of the defense and aerospace peers over the last 5 years? Okay, questions what we're about to do? All right, 10 minutes, and then we'll talk through it. Have some spokespeople ready to go. And then for those of you on video, I'm going to stop the video.